I think when you look at next year, there's a couple of questions that are going to play a key role in how 2013 is going to be evolve. And in fact, the interesting thing is that an answer to those questions are actually going to be given over the next couple of weeks. So I think over the next couple of weeks, you're going to see a couple of really crucial decisions. You know, will the euro crisis be controlled? Well, that's of course an ongoing process. But in December, well, you know, first we're looking at this discussion about the EU budget, but that's a longer term issue really. But in December, at the summit in December, which I think is around the 12th of December or something like that, the European Commission is going to submit plans for a banking union, and that's going to be quite an important step in keeping the Eurozone viable. I'll get back to that in a sec. Over the next couple of weeks, I suppose the Americans must decide whether they want to commit suicide or not. If they decide that may not be a very clever idea, they will have to agree somehow to avoid the fiscal cliff. The fiscal cliff being the following: you know, in the past, the Americans have taken all sorts of measures to support economic activity. Many of these measures on a temporary basis, and as it so happens, a large number of those measures expire at the end of the year. If they don't do anything, there's going to be fiscal consolidation to the tune of 4 to 5% of GDP, which would almost certainly push the US economy into a recession, and that mightn't be so nice for us either. So the idea is, you know, they must change the cliff into a slope. That's the issue. And then, of course, just to focus a little bit on another part of the world, but crucially important, we've seen a significant slowdown of economic growth in the emerging world in the course of this year, and particularly in China. And the question is whether they can bounce back or not. So these three things I think are very important questions for next year. So, you know, Chris didn't say it, but implicitly perhaps suggested that I tend to be on the optimistic side. Is that correct? Yeah. Okay. Yeah. Okay. Yeah. Yeah. Probably. Well, actually, there was a time that I was very pessimistic, to be honest with you. And I didn't like it so much. And also I discovered that the market for pessimistic economists is overcrowded. And you know, it's better to be a niche player, and so I moved to the opposite side. When you look at sort of the problems that we're struggling with in Western economies, which is basically a massive debt problem, I think it is fair to say that our policymakers must do a couple of things at the same time, and it's a very hard juggling act. Maybe you can make this list a lot longer, but you know, these for me are the 5 most important things that our policymakers must do. Heavily indebted countries with large budget deficits, no matter what their economic circumstances, no matter whether you're Keynesian or not, you know, we have to get public finances back in order. You cannot run economies with public finances that are in a mess. So we need fiscal consolidation. We also need financial stability, which means that we do need the banks to be stable, perhaps to be strong. We don't have that everywhere, so we need to strengthen the banks. We also need economic growth, because it's much easier to grow out of problems than to shrink out of problems. There's a lot of progress we can make there, so we need. This always sounds very vague, but we need structural reform to improve our growth dynamics. We also need, I think, here and there, where debt levels are truly excessive, and there's no chance of the debtor fulfilling all his obligations, we probably need selective debt relief. And at the same time, then we need central banks that support this whole process and keep the thing flowing, provide enough liquidity, and provide enough monetary stimulus to achieve, you know, at least some growth if they can. Now, it's easy to list all those things. The problem is these things, you know, they work against each other to some extent. And what is crucial, and that's why I put it in bold, you know, what is absolutely crucial is that we do these things in the right balance. I would argue that the Americans, they seem to have found, you know, quite a good balance. I think that's the problem in Europe. I think we don't have the right balance. I think in Europe, with hindsight, I think we're relying far too much on fiscal consolidation. We haven't sorted out our banking problems. These are areas where the US is a lot better. Of course, we're also far behind in terms of structural reform. So I think in Europe, unfortunately, we haven't got the balance right. Now, I'm quite encouraged by the fact that Greece is getting 2 more years to sort itself out. Probably they need 20 more years, but you know, at least 2 more years is a beginning. And I'm also encouraged to see last week the European Commission said to Spain, look, Spain, you are not going to meet your budget targets for this year, nor are you going to meet them for next year, but we're not going to demand more austerity from you because you've already done quite a bit and you're doing structural reform, and you know, good luck with it. So there's some leniency, you know, coming to that process, which I think, you know, and don't get me wrong, I'm not a Keynesian, and I'm not, you know, I do think that you need to keep pressure on countries that are in a mess to sort themselves out, but the pace at which you do that is very important. Economies like the Greek economy, you know, frankly, they've been completely destroyed, and that society has been significantly damaged, and that's very sad, and actually it's no good for anybody, and it's you know, it's not really in our interest either. So I think we need a much better balance between all these things. There's sort of you know, message, sort of a personal message. It's not knowledge that is going to be helpful to you in your daily life, of course, but I just wanted to say it. Feels a little bit like a speech at a funeral, but anyway. But it is important, and I do think, okay, maybe that's the positive. You're looking for the positive. You know, it seems like Europe realizes it's got the balance wrong, and it's trying to improve on that. Okay, let's look at the world economy. Where are we? Well, the world economy is weak and vulnerable, but at the margin, at least things seem to be stabilizing. I always like to look at logistics flows, world trade flows. So what I have here, the yellow line is world trade growth, and the green line is an indicator I watch closely every month, which is the freight turnover in Frankfurt Airport, which is quite a decent proxy for world trade growth. Frankfurt being the largest airport for freight in continental Europe, and the data is very easily accessible. and what the graph shows, at least my reading would be that in the course of 2011 and also actually in 2012, the thing was very weak, but it's stabilizing. It's moving in the right direction. The green line is still below 0, and if you look at the actual underlying numbers, there's not an awful lot of improvement, but at least it's stabilizing. So, and when I look at other logistics data, so when I look at sort of trade flows and container sort of movements, especially in Asia, you see a similar pattern that, you know, the world trade is stabilizing and at the margin is improving. Now, the question, of course, is why is that, and is that sustainable? I think an important reason why that is in my opinion, in the course of 2012, worldwide companies got quite nervous, and they cut down on production levels. They cut down on production levels excessively, really. As a result, they had to draw down inventories, and as they brought production levels below demand levels. Then you draw down inventories to fulfill that demand, I suppose. But it lowers the overall activity level in an economy. The good thing about that is that process comes to an end at some stage. I think that's now bottoming out, and I think worldwide we're starting to see a careful sort of rebalancing, if you like, a careful rebuilding of inventories. Of course, the picture is very diverse between different industries, but if you try to get an overall picture, I think that's a pretty fair assessment. Significant inventory drawdowns in the course of 2012 that are now stabilizing and likely to be followed by the opposite, by careful rebuilding of some inventories. The result will be, I think, that over the next couple of months, perhaps quarters, maybe 2 quarters, we're likely to see slightly better sort of cyclical indicators. Now, is that something to cheer about? Well, actually, yes, because it could be a lot worse. And so that is nice. But obviously, that doesn't guarantee that 2013 is going to be a fantastic year. Not at all. But at least it is a small positive, and perhaps that can give a little spark, and things can build on the basis of that. Now, while I like to look for the positives, I'm not an idiot. At least I think I'm not an idiot. So I'm willing to recognize problem areas. There's a couple of areas where I see divergence that I think is unusual and that is unlikely to be sustained. And some of these things actually scare me. I'll go a little bit deeper into the first one there, but just sort of as an observation, from a cyclical point of view, the US and emerging economies seem to be doing okay-ish. Europe is really not, and Japan is also terrible. It's unusual for large economies that dominate the world economy to diverge. And it happens sometimes. It doesn't tend to last. So either Europe and Japan will speed up over the next couple of quarters on the back of the US and the emerging economies, or the opposite, or somewhere in between. But this is a divergence that is unlikely to last for extremely long. Then in Europe, you have a divergence. The first one, you have a clear divergence between the developments in core economies and peripheral economies. That is quite likely to last, actually, simply because the peripheral economies continue to be forced into austerity. Then there's also a strange divergence that we have noticed between hard data in Europe and confidence data. I have a graph on that I think is interesting. I hope you'll find it interesting. That is a divergence that is unlikely to last, I think, but which way it's going to go, we're not sure. And then at the moment, I also see a worrying divergence in the US, where the jobs market seems to be okay, actually seems to be quite good, but corporate investment seems to be very weak. Now that is certainly something that can't last extremely long. So I'll focus, talk you through our picture of the world and focus on these sort of areas. Now maybe I can start with Europe. I mentioned that there was a divergence in Europe between the hard data and the confidence data, and that is sort of shown here. This is a very simple graph, really. The yellow line is business confidence, measured in what is called the PMI, the Purchasing Managers Index, usually a very reliable indicator of what is happening in the economy. And the green line is the green line is actual industrial production, which we have sort of manipulated a little bit. It's, for those of you who are into the statistics, it's 3 months over 3 months measured, and I don't think it's annualized, and no, it can't be. Okay. What it shows is, I think, that generally there is a decent relationship between the two, but what is very striking, of course, is the development here with confidence coming off and actual production improving. So the question is, why is this happening and can it last? Well, the last question is fairly easy. It can't last, or at least it doesn't tend to last. And to be honest with you, in the past, whenever we've had a little bit of such a divergence, by and large, the PMI has been right and the actual numbers have been wrong. So if I want to be optimistic, I need to argue convincingly that now it's different. And those of you who are seasoned investors know that there are very few words that are so expensive as now it's different. But in this case, I'm still going to try it. I think what we're seeing here is a couple of things. One is confidence is low because of the continued negative flow of let's say, news about euro area problems. So that partly explains why the thing goes down. The green line goes up. Well, why does that go up? I think for two reasons. I think It has gone up, well, partly because there's been a bit of a rebound in car production over the summer. That may fade, and then the green line might fall. But there's been something else happening in Europe, and that is that the peripheral economies, for all their problems, they have actually managed to improve their competitiveness. And you're starting to see that the improvement in competitiveness is starting to have a bit of an impact on their trade numbers and also on their activity numbers. You need almost a magnifying glass to see it, but I think it is there. And anecdotally, you probably saw, I saw it, I think it was the day before yesterday, at least this week, that I think Renault announced that it was creating 1,300 jobs in Spain, and they're moving car production, I don't know from where to Spain, but I think it's within Europe, so it's not a win-win situation for Europe, but it does show that a country like Spain is becoming more productive. And I think earlier Ford decided to move some car production from Belgium to Spain. So these sort of anecdotes suggest that the competitiveness in Spain is improving. And I think, you know, overall, you're starting to see that in the trade numbers. In fact, the trade deficits of the peripheral countries, they've shrunk quite a bit, partly because of the recession, but also partly because, by and large, their exports are actually doing reasonably well. So I'm hopeful. I'm hopeful that in this case, you know, the PMI over the next couple of months and quarters will improve and maybe not close that gap, but make a significant contribution to narrowing that gap. Now there's something else in Europe that worries me a lot, and that is corporate investment. When you look at what corporates are doing, you know, it's basically worrying. An economy cannot really grow unless corporates are doing well and they invest. Now, corporate investment is shrinking, and leading indicators for corporate investment aren't looking so great. One thing we look at is this. When I put this presentation together, I was wondering whether I should bring this graph. The reason for my doubt is, you know, it totally undermines my story. But I thought I'd better be transparent and open and fair. You know, apparently that's what bankers these days have to do. So somewhat reluctantly, I comply. Okay, what it shows, the green line is simply investment spending as a growth measure. You can see it, you know, in 2010, it moved positively, and then it turned again, and towards the end of 2011, on a year-on-year basis, it was below zero, and now it's fallen a little bit further. Measured on the left is not a disaster at all, but it's certainly not a great story either. Now, as a lead indicator for that, we sometimes use the European Central Bank's bank lending survey. I've mentioned that bank lending survey many times before here. It's a survey that the ECB carries out once every quarter. It asks the banks lots of questions, usually about whether they ease or tighten credit criteria, lending criteria. But another area where they ask questions is about loan demand. And banks give very interesting answers. And the yellow line is what banks, Eurozone banks, answer in the ECB's lending survey to the question, you know, what do you see in terms of loan demand from companies? And that is very, very negative. And if you push that forward a little bit, you know, it seems to have quite a nice relationship with actual investment. And the message, of course, that is why it doesn't suit me. The message, of course, is that it's going to get worse before it's going to get better. In fact, that yellow line is at a, well, let's say at a disappointingly low level, not too far above the really low levels in 2009. So if these sort of data, if they indicate that corporate investment is going to shrink further, and that's what they're implying, you know, that's not great news for Europe at all. So Europe really doesn't have an awful lot of growth dynamics internally. Now, if we step away a little bit from the cyclical developments in Europe and we talk about, what does Europe need to do to make the euro viable, it always helps me to distinguish things that will help, that are needed from a sort of structural point of view, and that will help make the euro ultimately viable, but that may not help us in the short term, but they have to be done. And most of those things have to be done by the politicians. It's an illusion to think that the ECB can make the euro viable. In fact, the ECB cannot make the euro viable. The ECB can buy time, the ECB can keep something going for a while, but it cannot solve the problems that we have. The politicians need to do that. Now, what do they need to do? You can probably make that list a lot longer. Okay, I have just 4 points there. Again, you can make them longer. And when I look at those things, I'm actually quite encouraged, because on all those points we are slowly, but gradually making progress. Public deficits, public finance deficits are reducing. We do have much more convincing budget rules. You probably remember that we operated the euro under the Maastricht criteria, and you probably remember what those criteria meant and what they were about. They were very simple. Do you remember how large budget deficits of euro countries were allowed to be as a percentage of GDP? 3, exactly. And debt to GDP? 60, exactly. So we had very simple rules, and basically everybody knew them. Okay, did we stick to them? No. The debt ratio was thrown out immediately. I suppose only Luxembourg ever really met that criterion. And the funny thing is, of course, Luxembourg could not be a monetary union of its own. In fact, before we had the euro, they were part of a monetary union. They had a monetary union with Belgium. So the debt ratio was completely ignored. And even the deficit criterion, the 3%, was also ignored largely, particularly when in 2003, 2004, Germany and France didn't comply with that criterion. Excessive deficit procedures were not undertaken against them. Nobody took action against them, and that really undermined the credibility of the whole thing. Now we actually have, a rather impressive set of new rules. I think the rules are great. Okay, whether they will work remains to be seen. And there is another problem with these rules, and that is that most people don't know them. Now, as long as the politicians know them, you can say, well, they have to do the policy, but it's also important that the people know these rules, right? And when I do talk to people like yourselves in the Netherlands, I usually ask them a couple of questions about these new rules to see whether they're aware of them. So maybe you will allow me to ask you also a few questions about these rules to see whether you're aware. Of course, why should you be? You're in a different regime altogether. But have you ever heard of the European semester? No? Do you have newspapers here? Yeah. Yeah. Internet? Yeah. Okay. What about the fiscal compact? Yeah. If I gave you a piece of paper, we did a test, and you had to write down what the fiscal compact was, do you think you'd pass the test? No? Oh, okay. There's another element of it. There's actually an element that the Dutch people tend to know. The six-pack. Yeah, it's a different six-pack, obviously. Well, actually, you're not doing any better. You're not doing any worse. Apologize. You're not doing any worse than Dutch people. We have a very complex set of rules. Very complex set of rules that look good on paper. It needs to prove itself in practice. But one of the problems is nobody knows them. And in fact, it is so complicated that in the Netherlands, we just got a new government, and they issued a program for government with a long-term sort of finance plan. And we looked at the finance plan, and we asked the question, well, does this plan, is that in compliance with the new European rules? So I asked one of my guys, I said, look, I'm not sure, but I suspect it's not compliant, but I couldn't tell. But what's the answer? And he took 3 or 4 days to find out. And he's a trained economist who's focused on this stuff. And even he found it very, very difficult to determine whether the Dutch budget, longer-term budget plans are compliant with the Euro rules. The answer was no, they're not compliant. So I suspect that guys in our finance ministry even didn't realize. Anyway, we'll find out. But very, very complicated. So I think that's a problem. In terms of structural reform, we are making progress, but it is a very slow process. And then the banking union, I mentioned earlier, we're going to get proposals for the banking union. You can probably debate as to what a banking union really is. I suppose most people at this stage understand a banking union to be something that consists at least of 3 things. First of all, in this case, a European level supervision on the banks, at least on the main banks, but probably on all the banks. And if you have that, you probably also want a European level deposit guarantee system. And you probably also want some sort of a resolution mechanism, so that, okay, you can supervise banks, but what do you do if a bank is going to be closed down? You need some sort of a resolution mechanism. They either now are non-existent or they exist at a national level, but it'd be odd to have a European supervisor and national resolution mechanisms. Now, unfortunately, these sort of negotiations are extremely complicated, and unfortunately, what we seem to be getting in December is we're going to have sort of the European supervisor, which is likely to be the European Central Bank, but we're unlikely to get the deposit guarantee system and also unlikely to get the resolution mechanism. But at least we're making, we're moving in the right direction, and these things, hopefully they'll come later. So we need a lot of things, and most of these things we're actually making some progress. Then I think you have these shorter-term issues, and that's where the ECB has an important role to play. We need continued access to funding at payable costs for governments. We need a financial system that is stable, and as far as possible, the ECB needs to support economic growth. I was recently at a meeting. I meet with the economists of the Dutch Central Bank every 6 months or so, and recently at this meeting, and they asked me what I thought of the ECB policy, and in fact they phrased it slightly differently. They phrased it more like, aren't we doing a fantastic job? Which obviously no was going to be the wrong answer. Even I understood that, so I said, yeah, you are doing a very good job. And in fact, my guess would be if you're going to change anything, you're going to be even more aggressive. And they said, how can we be more aggressive? So, well, easy, you can go to negative interest rates. This is actually something, believe it or not, negative interest rates is something that they're thinking about. I'm not saying they will do that, but it's something they're thinking about. And of course, the Danish central bank is experimenting with it, and the let's say the early parts, the very short parts of the yield curves in a number of bond markets, you have negative yields. So it's not completely something new, but this is something that may become even more widespread. And I said to them, maybe you're going to be really forced into quantitative easing at some stage. You're reluctant to do that, but maybe you need to do that. And they said, well, why do you think that we need to loosen policy even further? And my answer was very simple. I said, look, our economy is stagnant at best. And I think a decent measure of whether monetary policy is easy enough or not easy enough is probably the exchange rate. And as the euro is, in my opinion, still overvalued against the dollar, and that's not what we need, it's probably telling you that ECB policy on a relative basis is maybe not easy enough. So that combination, stagnant economy and a relatively expensive currency, at least against the dollar, suggests to me that the ECB may be forced to ease policy further. Now, that wouldn't be our main scenario, but our main scenario is they'll stay where they are. But my guess would be if they're not staying where they are, the chances that they'll ease further are much bigger than that they'll somehow tighten. Now, the negatives for Europe, I don't need to tell you that they're in the media all the time. There's a couple of positives, I think, which I've listed. Should I, yeah, maybe I should be somewhat, self-reflection is a great thing. So maybe I can reflect myself a little bit in a somewhat critical way. When I look at my own list of positives, the fourth one I find quite interesting. When somebody says, I'm optimistic because fiscal consolidation is not going to get any worse, then you have to think, wow, it's not a very strong story, is it? If this is going to get better because it is not going to get worse, it is weak. I will admit that. But it may be important. Over the last couple of years, fiscal policy has been extremely restrictive, has slowed economies down, and I think that will continue. But the degree to which it will continue, the worst of that is probably behind us, and it's certainly not getting any worse. If anything, it probably becomes somewhat better. But the big strategy in Europe, if you're really a visionary economist for Europe, you'd say, well, the biggest chance that Europe has to improve in 2013 is the last one. We're waiting for an external lift. This is sort of, some countries have these policymakers that are extremely good at trying to be lucky, and that's in a sense, from a cyclical point of view, that's probably our strongest card to play. The world outside Europe may be doing well, and we're on the back seat, and we can move along with them. Now, so let's have a look at the world outside us. Is the world outside going to provide a little bit of help to us? There's a couple of areas where there is meaningful improvement. One is the housing market. House prices have started to increase. I realize that you will say, well, I'm not impressed with that. That is sort of price increases of, 3% perhaps, or thereabouts. Not very impressive, but, it's a lot better than what we had. From a valuation point of view, US house prices actually started to look cheap. Affordability is at very good levels. And the more recent development, I'm looking here at a year-over-year comparison, but if you look at the last couple of months, and you compare that, so you measure the most recent speed, you're more in the 5 to 10% range. So that is starting to, that's starting to move in the right direction. Of course, house prices increasing, it makes a big difference to an economy from house prices falling. House prices falling for a persistent period zaps energy from an economy, and when that process stops and you have house prices rising, you get a lot of dynamism from that. So it's an important change. And in fact, it has led to my next chart, which is my next chart is the most exciting chart I have with me. This is housing starts. When you look at it, so this is a good indication of residential construction activity in the US. Before the crisis, okay, they were building like crazy, but they were starting over 2 million homes. They were over 2 million homes a year. Then it collapsed to just over 400,000. So it collapsed 75–80%. Incredible collapse of construction activity. And in fact, it collapsed to a level where you say that the US is basically not building enough houses. We can work out what the increase is in the number of households in that country. And there's a trend in that. Of course, from year to year, it can change. But if you look at the trend, the number of households that are formed every year on a trend basis is well in excess of the number of homes that they're building. And there can only be one conclusion. The conclusion is they're going to build more homes. And that process has now started to happen. Of course, you can say, well, how can this be? What is happening now then to these people that should have been buying homes? Well, actually, they're staying at home for longer. Young people stay at home for longer. And of course, at some stage, that's very nice and cozy. But at some stage, and I speak from experience, you know, you appreciate, you know, that they bugger off. On a personal level, I have a 50% score. Two are gone and 2 to go. But you know, what we have created here is a lot of pent-up demand for homes, and that's going to come out, and it's happening. You know, I know that you think you know, they're hardly moving. Well, really, but look at the numbers. You know, it's so low. From the most recent reading compared to a year ago, it's up 40%. You know? So if I had drawn the graph from here, and of course I'd taken a different scale, this would have been a spectacular line up. It has increased 40%, and the good news is it's going to increase more, significantly. When I look at the number of housing starts on average in the 1990s, and why wouldn't we go back to something like that? You know, it will still have to double from current levels. So my assertion would be, you know, chances are the process has started, there's a lot of pent-up demand, process has started, there's going to be a very significant boom in residential construction activity over the next couple of years. And you know, this is actually something that you must keep in mind. You know, a pent-up demand is fantastic. You know, because it gives it gives an enormous boost to activity. The more pent-up demand you have, you know, the better, really. There's other areas of the U.S. economy that are also improving. The labor market is improving. There was a debate prior to the elections as to whether or not the Obama people were rigging the numbers, and Jack Welch, former CEO of General Electric, was saying that the surprisingly good labor market data recently, that they basically weren't describing the truth. I think it's completely wrong. I see lots of indicators that, you know, altogether suggest that there is something happening there. It may not be excessively strong, but there is definitely, the labor market is improving, and there's supporting evidence for that. For example, consumer confidence is quite strong. That wouldn't happen if the labor market were very weak. Now, having said all that, there is also something to worry about in the US. Of course, there are lots of things to worry about. You know, one thing, actually, I'm not going to dwell on that, but you know, the incredible inequality in that country is obviously something to worry about. It's a problem, but it's not a problem that's necessarily going to derail the economy in 2013, but it's a longer-term problem. But something that is more of a short-term concern is this graph. This shows non-farm payrolls, so employment growth, which is the yellow line, and the green line is core capital goods orders. That is a proxy for investment spending by corporates. And you know, by and large, okay, the green line is much more volatile, but by and large, it tends to follow the same, roughly the same pattern. And of course, what we are seeing very recently is, well, employment growth is continuing, but capital goods orders are basically they're collapsing, because the level that we're at now is sort of comparable to the recession of 2001. And you know, this divergence, the question there must be, you know, why is it happening, and can it last? I would think it can't last, because why would companies continue to hire people but not invest? You know, that doesn't make an awful lot of sense. Now, what commentators offer as suggestions for weak capital investment at the moment is that it is the fiscal cliff that is making companies shy to invest. Now, if that is true, why they're not shy to hire people, I'm not sure, but maybe it's because they hire sort of low-paid people, or they think they can get rid of them again. I'm not sure, but there's something funny going on here. I think when I look at the whole picture of the economy, I'm very surprised to see such weak capital spending data, and I suspect that the fiscal cliff and the political uncertainty surrounding that has something to do with it. So I suspect that if they can get away from the fiscal cliff, if they can turn that into a slope, then capital spending must improve. In other words, there may also be pent-up demand here, and perhaps this is a potential for upside surprises next year. Now, what do you think? Do you think that the US will fall off the cliff? What some commentators have said is, okay, we got the elections. Prior to the elections, the two parties couldn't agree on how to dismantle this threat of the cliff. And after the election, nothing has changed because we have the same president. We still have a Democratic majority in the Senate, and we have a Republican majority in the House. So the political stalemate has continued. However, I would argue that after elections, political dynamics change. Prior to elections, you can't be seen to compromise with your opponents. But after elections, and with the next elections at least 2 years away, or maybe 4 years away, well, if you're going to compromise, you better compromise quickly. Another element is, in the elections, sort of not highlighted an awful lot, but the Tea Party is now much weaker than it was a year or 2 years ago. The Tea Party being the more extreme part of the Republican Party. I think the environment is there for compromise to be much more likely than for that not to happen. So I'm not, what do I know about these things? But I'm hopeful that they will actually reach some sort of an agreement so that they at least reduce the amount of fiscal consolidation that's now scheduled to be about 4% or so, 4% of GDP, and they reduce that to a much lower level. Now, they don't need to reduce it to zero, because the US, most people don't realize this, but it has already gone through a reasonable amount of fiscal consolidation. In fact, the US budget deficit has actually already fallen quite a bit. These are monthly numbers. The US federal budget deficit has fallen from a low of deficit of 10.4% to the most recent number, just better than 7%. So there's already 3.5% of the deficit is shrunk away, partly because of measures they've taken, partly because of growth they've had. So they have already had fiscal consolidation, which has depressed economic growth. I think if they can move the cliff from 4% to maybe 1.5%, certainly that wouldn't depress growth numbers to levels below what we are currently seeing. I'm optimistic, but it's more an assumption than a forecast that they will reach something that will allow the economy to grow at a fairly decent pace next year. Now, what about emerging economies? China, perhaps. One of the questions you have to ask is, well, why did China actually slow? There's probably a couple of reasons, probably many more than I've listed here, but one is, well, they wanted to slow. They felt they were growing too rapidly. They tightened policy. They basically stepped on the brakes somewhat. Another thing they did, which is also policy-driven, is 2 years ago they introduced a new 5-year plan. They introduced a new growth strategy. They had a growth strategy that was mainly based on exports and investment in infrastructure and residential construction. And now they have said, okay, over the next 5 years, we want to move away from such a growth model to slightly more emphasis on real domestic consumption. And the implication of that probably is, you're going to reduce your growth numbers. So it's partly policy-driven. It's partly because of Europe, the global cycle. Perhaps also partly because of, continued appreciation of their currency, rising wages. Maybe all these factors have contributed to slower growth. Now, in terms of the policy, I think the policy has changed somewhat. They've taken the foot off the brakes. They're tapping the accelerator here and there. There's not huge stimulus, but at least I think that they've stopped braking, and the inventory cycle seems to have changed there as well. So overall, it seems to me likely that economic growth will reaccelerate somewhat. I wouldn't think it's going to be massively strong acceleration, but somewhat. And that is happening, here. I know that, economists are sort of sad people when we get very excited about these sort of developments. But after a slowdown like this, it's quite nice to see this. And okay, sometimes the thing can be volatile, but by and large, when you see these things turning, they tend to continue in that direction for some time. And I think there's a story, there's arguments underneath it. So my view would be emerging economies, China, will accelerate somewhat into 2013, and it'll be to the advantage of us as well. Now, if I take that all together and I move to what does it mean for financial markets? Well, first of all, monetary policy will remain extremely loose. And if anything, in the Western world is going to be even looser than what it already is. For a long time, everybody was searching for yield. Well, the yield is gone. So if you want to continue searching, you have to search for something else. I suggest that you search for return. Actually, probably more relevant than searching for yield. And if I'm right that the outlook is for the global economy to muddle through and perhaps surprise a little bit on the upside, then surely, given these things, then surely next year risky assets must be able to perform relatively well. This is a graph of, this is something you're more than familiar with, I'm sure. I was recently at a meeting of a Dutch pension fund, a 12 billion pension fund, not a small fund, not huge, but not small, and they were looking at their investment plan for 2013, and they had worked out that they're likely to achieve a return of 4%. And we discussed whether that was enough, and obviously for a pension fund, it's not actually, it is for a year, but on a long-term basis, you would like a little bit higher return than 4%. So when we looked at, well, why is it so low? Well, it's very easy. It's a fairly cautious fund, and it has 30% of its assets in financial instruments that yield less than 2%. Now, you can get a high return on that if interest rates continue to fall, but I mean, how can you get a return from these incredibly low yields? In fact, if you want to be sure, if you want to be virtually sure that you're going to lose money in real terms, this is where you need to be. Of course, being sure to lose a little bit in real terms may be better than to lose a lot in risky assets, and some investors obviously choose this. But I can't understand how this could last for an extremely long period of time. On the equity side, there's two things. First of all, Europe has underperformed the US for quite a period. That's partly justified, but partly not in our view. So we would expect in 2013 a bit of reversal here. And on valuation, if we're right thinking that the economy will do okay-ish next year, I think earnings will be okay, and that implies then that equities generally, this is for the S&P, the price-earnings ratio, but equities generally are fairly reasonably valued. So if I conclude, well, the world economy is weak and vulnerable, and there's lots of risks, but some of the risks are gradually being reduced. The ECB is playing an important role in that. I do think there's a couple of important positives to take note of. The glass is half full, and there's a trickle of liquid into the glass. It's getting a little bit fuller. I'm assuming, but it is an assumption, I'm assuming that the European policymakers keep the euro crisis under control. I'm also assuming that the US avoids the cliff. I'm also assuming or forecasting that China makes a successful transition in a number of areas and reaccelerates a little bit. And the conclusion of all of that would be that risky assets should perform reasonably well next year.